You know that feeling? You open your brokerage app, and for just a second, your brain just refuses to process what it's seeing. Red. Everywhere. Percentages with a minus sign. A portfolio that looked completely different just a few weeks ago. If that's where you are right now, hey, welcome to 2026. Look, the stock market has had a rough stretch. Geopolitical tensions, shifting interest rate expectations, AI-driven speculation, all of it colliding at once. And for a lot of investors, especially the newer ones who've only ever seen markets go up, this is genuinely unfamiliar territory. But here's the thing. This moment, uncomfortable as it is one of the most important investing opportunities you will ever encounter. The question isn't whether the market will recover. History's pretty consistent on that. The real question is, what do you do right now? Let's break it down.
Okay, before you make any moves, I need you to understand something important. A drop in the stock market is not the same thing as a collapse of the economy. Say that again with me. A correction is not a catastrophe. Markets are forward-looking. They react to fear, to uncertainty, to shifting expectations, often before the underlying fundamentals have even meaningfully changed. What we've seen in 2026 is a market dealing with several things at once. The hangover from years of easy money, a recalibration around AI valuations, geopolitical instability pushing energy costs higher, and big investors rotating out of growth bets and into more defensive positions. That context matters, because here's the thing. This is not 2008. Corporate earnings for S&P 500 companies still projected to grow above 16% this year. Consumer spending hasn't collapsed. The economy is still expanding, just more slowly, more unevenly than before. Understanding that is what separates the investor who stays calm from the one who panics and sells at exactly the wrong time.
Okay, I want to be honest with you about something. Most people don't lose money in market downturns because of bad stock picks. They lose money because of bad decisions. Specifically, selling at exactly the wrong time. When markets fall, every instinct in your body screams, "Get out!" That's biology, not strategy. Your brain is literally wired to treat financial loss the same way it treats physical danger. It wants to run. And the financial media, with its endless parade of alarming headlines, is more than happy to pour gasoline on that fire. But here's what the data actually shows. The investors who come out ahead, they're not the ones who predicted the drop. They're the ones who had a plan before the drop happened and followed it when things got scary. So before you buy or sell a single share right now, ask yourself honestly, am I making this decision based on my strategy or based on how I feel this morning? If the answer is the latter, step back. Go for a walk. The market will be there tomorrow. All right, let's get into the actual strategies. And I want to start with one that sounds almost too simple to be real. Dollar cost averaging. Instead of trying to find the bottom, which, by the way, even professional fund managers rarely do successfully, you invest a fixed amount at regular intervals, regardless of where the market is. Here's why this works so well right now. When prices are lower, your fixed investment buys more shares. When prices recover, those cheaper shares gain value faster. Over time, you accumulate a lower average cost per share than if you tried to time everything perfectly. But honestly, the real power of this strategy isn't mathematical. It's psychological. It removes emotion from the equation completely. You don't need to decide whether today is a good day to buy. You already decided. The transfer is automated, the amount is fixed, and you show up every 2 weeks like clockwork, whether the market is up, down, or sideways. The people who built real wealth through market cycles weren't the ones refreshing their portfolio every hour. They were the ones who kept buying quietly, while everyone else was panicking. Here's something a market drop is actually useful for. It reveals very quickly whether your portfolio actually matches your risk tolerance. Not the risk tolerance you think you have, the one you actually have. If you're losing sleep over your current paper losses, that's important data. It means your allocation might be too aggressive, not for your aspirations, but for your actual emotional and financial situation. The classic guidance is simple. Your portfolio should reflect your time horizon. If you're 30 years old investing for retirement, a short-term correction is essentially irrelevant. You have decades of compounding ahead of you. But if you're 58 and planning to retire in 3 years, that's a very different calculation. Now is a good time to rebalance. A sharp drop in equities might have shifted your portfolio toward more bonds or cash than you intended. Or if you were heavy in growth stocks, you might find yourself more concentrated in tech than you'd like. Rebalancing means selling what's grown too large and buying what's shrunk, which right now often means buying equities at reduced prices. Rebalancing isn't about predicting the market. It's about maintaining the risk profile you originally signed up for.
One of the clearest lessons from 2025, and honestly, it's been a wake-up call for a lot of people, is that concentration risk is very, very real. For years, the US large cap market, particularly the mega cap tech names, drove almost all of the returns. And it felt like diversification wasn't necessary because the winners just kept winning. That dynamic has started to shift. Investors who held international equities, bonds, gold, have had a meaningfully smoother ride during this recent volatility. This doesn't mean abandoning US stocks. It means acknowledging that a portfolio heavily tilted toward a single country or a single sector carries risks that aren't always visible during bull runs, but become very obvious when things turn. Diversification isn't exciting. It will always mean that some part of your portfolio underperforms in any given period. I know that's annoying to hear. But it works. It reduces volatility. It smooths out returns over time. And most importantly, it makes it easier to stay invested without panicking. Okay, here's one that most people completely overlook, and it's honestly one of my favorites. There is a silver lining to a down market. Tax loss harvesting. If you hold positions that are currently sitting at a loss, you can sell them, realize that loss, and use it to offset capital gains elsewhere in your portfolio, reducing your tax bill. And this doesn't mean abandoning a good investment. You sell the losing position, capture the tax benefit, and reinvest in something similar to maintain your exposure, just not identical.
Watch the wash sale rule if you're in the US. Done correctly, this is essentially free money that only becomes available during market downturns. And beyond that, a down market is also a great time to consider Roth conversions if you're eligible. Converting when your portfolio value is lower means you pay taxes on a smaller amount. And when the market recovers, that growth happens inside a tax-free structure. These aren't strategies for everyone. The specifics depend heavily on your individual situation. But if you're working with a financial advisor, these should be active conversations. Right now. I want to talk about something that often gets skipped in investing conversations, but I think it might be the most important thing on this entire list. Your investment strategy means nothing if a personal financial shock forces you to liquidate your investments at the worst possible moment. And yet, this is exactly what happens to people who invest without a cushion. If the recent market volatility has made you anxious, I want you to ask yourself why. And be honest. If the answer is, because I don't have enough liquid savings to cover an emergency without touching my investments, that is the most important thing to fix, not your portfolio allocation. A solid emergency fund, typically 3 to 6 months of essential expenses, in accessible cash or a high-yield savings account, is the foundation that allows you to invest with patience, with confidence. With that buffer in place, a market drop is an opportunity. Without it, the same drop is a potential disaster. Let me leave you with this. Here's what history tells us clearly and consistently. Market corrections are temporary. Bear markets end. Recessions eventually give way to expansion. The S&P 500 has experienced 56 corrections since 1929. 56! And in the vast majority of cases, markets fully recovered and went on to reach new highs. Now, that doesn't mean every individual stock recovers. Companies fail. Industries get disrupted. Concentrated bets can go to zero. That's real. But a broadly diversified portfolio held over a long enough time horizon has never permanently failed to recover from even the most severe downturns. What this moment calls for isn't heroics. It doesn't require you to call the bottom perfectly, or load up on the hottest sector, or make some contrarian bet that your friends will call brilliant in retrospect. It calls for something harder, and honestly, less glamorous. Discipline. Consistency. The willingness to keep showing up, keep contributing, and keep your eyes on a horizon that's measured in decades, not days. The people who will look back at 2026 as a turning point in their financial lives are not the ones who timed the market perfectly. They're the ones who didn't stop investing when it got uncomfortable. That can be you.